Here in the world of crypto, we've seen a thing or two. Stablecoin collapse, major hacks, frozen funds, defaulted loans. It's been a weird month. And in our darkest hour, a hero rises. Kind of. Two struggling crypto firms, Voyager Digital and BlockFi, received massive loans. See, the crypto industry is kind of on its last leg, and these loans are meant to help prevent total collapse and possibly some personal gain as well that we're going to discuss in a minute. The loans were supplied by companies owned by Sam Bankman-Fried, FTX, and Alameda Research. What's interesting about this is a lot of people are saying this story sounds awfully similar to a fella named JP Morgan. And I don't know about you, but it's been a while since I read my high school history textbook, so I don't remember much about another guy who single-handedly attempted to save an industry. But before we dive into this fascinating comparison, let me tell you about today's sponsor. Myself. Well, my company, Finova. Markets are extremely shaky right now, and it's great to have a friend in the finance business. On Finova, we have a massive community of investors chatting about the latest tactics and strategies and making a lot of money doing it. We have live coaching calls every single day, trade signals, research reports, and so much more for as little as $10 a month. There's really nothing else quite like it. Also, we are now running a 7-day free trial, so check it out for yourself, see if you like it. That is linked down below. Now, before we start looking into whether this comparison between Sam Bankman-Fried, let's just call him SBF, and JP Morgan is accurate, let's review some highlights, or lowlights. Is that a thing? Of what's happening in this horror show lately. A few crypto VC firms like Three Arrows Capital found themselves unable to pay back loans that they had taken out, usually on leveraged positions. It's almost always leveraged positions. Crypto exchanges like Celsius ran into liquidity issues, so they prevented customers from removing funds from the platform. It's a bit like watching dominoes fall. Each time a new exchange, crypto project, or VC firm ran into a problem, the more panic ensued and the worse this tailspin gets for the entire crypto market.
Oh my God! Okay, it's happening! Everybody stay calm!
What's the procedure, everyone? What's the procedure?
Stay calm!
This is what's called contagion. Only so many bad things can happen in an industry before everyone's like, I'm out, and the whole industry just collapses, or sometimes even the whole economy collapses for a while. Clearly, Celsius and Three Arrows Capital aren't the only crypto companies in trouble. The whole space is in rough shape. BlockFi, everyone's favorite way to pay with a credit card and get Bitcoin as a reward, was also running into liquidity issues. To help solve this problem, BlockFi announced that they had received a $250 million loan from FTX, Sam's crypto exchange. Just 3 days before that, Alameda Research, Sam's crypto trading firm, had agreed to loan Voyager Digital nearly $500 million in crypto assets. So, you might be asking yourself, why would SBF float these loans to his competitors? Well, he actually had a really good reason. In a recent interview, SBF said, "I do feel we have a responsibility to seriously consider stepping in, even if it's at a loss to ourselves, to stem contagion." Here is where the comparison to JP Morgan comes in. SBF appears to be bailing out the crypto industry by keeping major players in business, because if they failed, it would lead to a mass sell-off of assets, further depressing prices and making things worse and worse. Contagion. So it turns out JP Morgan did something pretty similar back in his day. See, this company called United Copper went bankrupt in 1907 because of a failed attempt by these two Wall Street bankers trying to corner the copper market. When their attempt failed, people began to withdraw funds from any banks or trusts associated with those two copper fanatics. Then, in the same weekend, two brokerages and a bank imploded on themselves. This was extremely bad back then because no bank account had FDIC insurance like we have now. So news spread and there was complete panic. People yanked their money out of the stock market and banks in fear of losing it all. And because banks don't keep 100% of deposits on hand, they can completely run out of cash and collapse. This is what's called a bank run. And here's a fun fact I just learned. Banks actually used to use this sneaky tactic to slow the draining of money out of the bank, where tellers would intentionally give customers back their money as slowly as possible. The whole thing got so bad that President Roosevelt became involved in trying to find a solution. So he phoned up the richest guy he knew, JP Morgan. He was like, "Yo, Pierpont, can you fix this?" I don't know how Roosevelt sounded. And Morgan was like, "Sure, I guess I got nothing else to do." So JP Morgan pledged his own capital and called together the most influential banks and trusts to all meet at his private library to work together and solve this issue. Think Tony Stark calling together the Avengers, or Captain America maybe, or Samuel L. Jackson. Anyway, the dude had some sway. He suggested that the largest banks invest in their smaller competitors, decide which banks would have to be sacrificed, and work together to make concessions for the good of the country, and probably make money while they're at it. So he locked them inside the library until they could come up with a plan to reestablish faith in the banking system. Well, he played solitaire in another room by himself. In the end, crisis was averted and people began putting money back in their bank accounts. And the thing is, this was the second time JP Morgan helped to avert a total economic collapse. The first time was during the Panic of 1893. This time around, the US Treasury was running out of its gold reserves, which backed the US dollar. At the time, gold could be exchanged for dollars at any bank, and many foreign investors were doing just that. This spooked the American citizens and things were falling apart. And mind you, the unified US dollar was only around for like 30 years at that point, so it was kind of new. So with the permission of President Cleveland, and a loophole created by the Civil War, JP Morgan gathered this team of international investors who agreed to buy US gold bonds in exchange for gold. And this reestablished trust for the dollar and avoided economic collapse. I don't know about you, but after looking at how much JP Morgan actually did and the amount of influence he was able to wield, it kind of seems like this comparison is falling apart a little bit. Like, yeah, SBF loaned some money to a few competitors to slow bleeding, but JP Morgan saved the freaking economy twice. However, as I dug deeper into the bailouts, I began to see more and more similarities. They both used chaotic circumstances to build their own empires. Throughout both the Panic of 1893 and 1907, JP Morgan gave out loans to banking competition, rival railroads — the man was super into railroads — and even industrial competitors. Through this process of swooping in when others were struggling, he established America's first billion-dollar company, US Steel. And the plan was simple: offer a loan to struggling competitors, but include some stipulations, like if you go bankrupt, I get full control of your company. The consolidation became so popular that the process became known as Morganization. SBF seems to be doing something similar, just in a more narrow space. In addition to extending loans to Voyager Digital and BlockFi, FTX also acquired the Japanese crypto exchange Liquid Global. And it turns out in August, FTX had loaned Liquid Global $120 million following a hack where Liquid lost $90 million. Then in August 2021, FTX US acquired LedgerX. In May 2020, they acquired Blockfolio. Then Sam acquired a 7.6% stake in Robinhood. This acquisition boosted Robinhood's stock by 36%. Bloomberg actually reported that FTX was on the verge of buying Robinhood, but they since responded that there are no active M&A conversations with Robinhood. Note the word active. Now, while writing this video, news was released that Morgan Creek Digital is raising money to counter FTX's offer to BlockFi. It turns out that FTX would be able to acquire BlockFi for next to nothing if they were to go bankrupt. Sound familiar? And Morgan Creek, as an early investor in BlockFi, would get the short end of the stick if that were to happen. Also interesting is that BlockFi chose to work with FTX as they were the only offer that protected clients' funds, which is totally nice to hear. Update: while this video was being edited, some news came out that FTX could soon purchase BlockFi, exactly what we expected. Now, this could be closed by the time you see this. The purchase price would be up to $240 million depending on performance, and this is down from their previous valuation of $3 billion just a year earlier. Update on the update: the deal went through. Now, the similarities between how both of these guys got even richer in the middle of chaos seems pretty clear, and you find this all over. Rich people tend to set up their base to make money in bad times, when the opportunities are there. But the most compelling similarities I found between these two required an understanding of their character and goals. This helps highlight their real intentions. JP Morgan was born into the business world. His dad was this prominent banker. However, he was really sickly as a child and couldn't go outside and play with the other kids, so he'd just stay indoors playing solitaire, studying, and reading financial statements. He was either going to be a mogul or a supervillain, and one of those two happened. But as a titan of banking and railroads and steel industries, JP Morgan believed that consolidation of these industries under the guidance of an honest and capable person would improve efficiency to the benefit of everyone. Morgan, even to his detractors and competitors, was widely known as being pretty honest and direct. While SBF's parents were not banking masters, they are both law professors, and they did instill in him some of his core business values. Barbara Freed, SBF's mother, describes her husband and two sons as take-no-prisoners utilitarians. She says the ethical goal of utilitarians is to maximize the total well-being of the world's people, and for some animals as well, that the goal leads utilitarians to focus their efforts on helping people in the direst straits, and on policy interventions that will lower the risk of existential threats to present and future generations. Sounds pretty good. SBF has adopted an ethos of effective altruism that urges people to use their time and resources to bring the greatest good to the greatest number they can. He believes that by creating the most wealth possible, he can help the most people possible. So not only do SBF's goals seem to reflect JP Morgan's belief that consolidation and expansion of one's business empire can be moral good, but like Morgan, he is also known for being pretty earnest and truthful. SBF's college friend Adam Yedidaya said that SBF is charismatic and that people knew he meant what he said. He seems like a pretty chill billionaire. However, even though FTX has sponsored my videos, I can't quite let them off that easy. I buy it that wealth in the right hands can promote ultimate good, and I totally believe SBF will do good things with his money, but we can't ignore personal desires as well. Bailing out crypto companies is in Sam's own interest. If the crypto market totally collapses, he's going to lose far more than the billion that he loans out. Plus, if those companies go under, he gets assets for pennies on a dollar. And of course, he just wants to win as well. When you're a billionaire, having money isn't even remotely a problem. But you can still win new battles and win new business. And that's what he's doing. And it's not necessarily bad, it's just human. If I were SBF, I'd say yes. I'm helping to save this industry. Yes, it's probably good for all of us, but I'm also protecting myself. I don't want to lose either. And people would be like, yeah, bro, I get it. I like money too. And they'd move on with their day. So overall, I think that these loans to crypto companies are a net win for the average investor. I'm glad that FTX and Sam did this. It's just going to mean more consolidation to a few key players for better or for worse.